According to Cathie Wood, this would be cyclical. So after more than 40 years in the market, whenever I hear the word shortage, I automatically think, since I do have a background in economics, that it means human nature double, triple, or quadruple ordering, and that NVIDIA's clientele is highly concentrated. Their cloud margins are also lower than NVIDIA's, so I'm sure they'll argue that at some point there's a problem with that picture because they're all designing their own chips. Yes, Cathie Wood has been following NVIDIA for a very long time, having done so since the company's IPO. However, ARK Invest sold a sizable amount of its NVIDIA holdings in November 2022, just before the AI-powered rally that drove NVIDIA stock skyrocketing. This move raised suspicions among investors, with some wondering if Cathie Wood lost out on big potential returns. In response to questions about possible oversupply, Cathie Wood has addressed the sale of NVIDIA shares. She is concerned that given the current market uncertainties, NVIDIA's clientele, particularly data centers, may be ordering excessive amounts of chips. Despite her reservations, this excess inventory could eventually result in a painful correction. NVIDIA is operating quite well right now. Their previous profit forecasts were surpassed thanks to robust growth in their data center and automotive sectors. But according to Cathie Wood, this very performance could be a red flag because the present high revenue multiple of NVIDIA's stock price indicates that the company may be overpriced. While NVIDIA is a fantastic company, Cathie Wood is renowned for her emphasis on disruptive innovation and long-term potential. What do you think? Was Cathie Wood right to sell NVIDIA? Or did she miss out on significant gains? She seems to think that spreading investments around would be a better strategy right now, since this enables ARK Invest to capitalize on other innovative firms with great growth potential. Kindly provide your thoughts in the space provided for comments below. S&P is trying to stay in the game. However, there was undoubtedly a slight decline in the bond's price over the final 30 minutes when manufacturing data came in and didn't change. Jim, the chief investment officer at SEI Investments at the New York Stock Exchange, said, "I want to talk to you a little bit about some of the numbers we got this morning, but generally as we go into next 6 months, that includes the election, how much visibility is there?" This was in response to a question about the general idea or big picture as we move into the second half of the year. Yes, we believe that some of that kind of confusion is still present today. As you point out, we've seen a little bit of a software manufacturing print, a dollar rally, and a kind of sell-off in rates. Of course, given that this is a holiday week, trading is likely to be somewhat light, but some of these themes are beginning to take shape. We've been major bond bears for the entire year, and we maintain that outlook for the next 6 months. We believe that the 10-year bond is somewhat priced in. The CBO released a report last week that was quite negative. If you are a bond investor, there is a lot of supply that will be coming onto the market in the upcoming years. We believe that this is somewhat underappreciated, and perhaps the market is beginning to process that. Our auctions have gone fairly well overall over the last month or so. I'm curious about the timing of this bond selling. One chart I've been observing is the dollar versus yields, which does seem to indicate that given the strength of the dollar, yields need to catch up. However, the fact that bonds are still being shredded at the moment, despite manufacturing being a problem, doesn't mean that the inflation component isn't still present. The industry pioneer NVIDIA, a graphics processing unit manufacturer, has been seeing incredible growth lately, largely due to the rising demand for AI chips. The Blackwell platform, the company's most recent innovation, is expected to build on this momentum and possibly propel its stock price to previously unheard of heights. The Blackwell platform is a revolutionary development in GPU architecture. It is designed to handle the enormous computing demands of state-of-the-art artificial intelligence models, providing a significantly higher level of efficiency and performance compared to earlier generations. This innovation is especially appealing to industries that use AI, such as robotics, autonomous cars, and data centers. Blackwell's design excels at parallel processing, which is necessary for computing in artificial intelligence. This feature allows it to execute intricate AI tasks with remarkable speed and accuracy, greatly increasing productivity in AI-driven applications. That seems to be absolutely correct. Still hanging in there, you know? Despite the action you're seeing in this morning's report, the market is essentially looking past it. Everything will be focused on Friday. Will we get another 200 plus points? After somewhat I would call softer prints, but off of some fairly heavy numbers earlier in the year from a CPI perspective. We've seen a trend solidify early in the year. It will take a few data prints for that to kind of work itself out. You can feel a little bit of relief from today's sell-off, if you will. We did have a fairly strong rally in the middle of the second quarter to get down to these, sort of, 4.3 levels. A lot of people are talking about range-bound being the name of the game as it relates to the 10-year Treasury bond. We see that range as being somewhat higher than what's priced in closer to 5%. When asked Jim to describe the relationship between stocks and bonds at this point, Jim responded that after being inversely correlated and the 60/40s being destroyed in 2022, stock bulls would want to see yields rise if the reason for the increase was the beating economic data. Well, I guess it depends on the rationale. If you believe the increase is due to a deficit, that's probably not a good reason. In any case, I believe that's correct. These mega-tech long-term growth names suggest that higher rates once we reach a certain point, we saw that last year, will not be good for the stock market. Therefore, we do see a positive correlation through the rest of the year, especially if rates flirt with the 5% level. That's where things got problematic in 2023 and 2022, and we believe that will happen again in 2020. Some of this was discussed in your most recent segment, as well as in the most recent segment where you saw the largest companies in the world. We are thinking about what it means when the second largest company in the world trades at an implied volume of 50. It tells us that, in all honesty, there might be some problems ahead even with its superior performance. That is something that worries us a little bit. Blackwell's exceptional energy efficiency is a crucial feature for data centers, where energy costs are high. Businesses can save money on Blackwell thanks to its efficiency, which encourages adoption. Blackwell is also easily scalable and can handle the growing complexity of AI models. This guarantees that companies may keep utilizing its capabilities as their AI requirements change, providing long-term value. For a number of reasons, it is expected that the launch of Blackwell will significantly affect the price of Nvidia's shares. Businesses from a variety of industries are anticipated to place a high demand for Blackwell due to its improved performance and efficiency. This increase in demand is anticipated to result in more revenue and profitability for NVDA, which will raise the company's stock price. Blackwell places Nvidia at the forefront of AI chip technology. This competitive advantage might help the business take a bigger chunk of the growing AI chip market, which would improve its earnings and stock price. Because Nvidia's innovation and dedication to staying at the forefront of technology are demonstrated on the Blackwell platform, investors are likely to be more confident, which will increase the company's capital and stock price. It's important to understand that Nvidia's larger AI strategy consists of more than just Blackwell. You know that the volume of individual names will be higher than that of a large collection of names, but the sheer size of these names makes us pause a little bit. If you're planning to add a Berkshire Hathaway to your market value in 30 days, you should take a step back and consider that. For the individual investor, that is the one item that we would probably mention and agree upon. Although Nvidia's future looks promising, it's crucial to be aware of any hazards. The technology industry is notoriously unstable, so unforeseen circumstances could derail Nvidia's growth trajectory in addition to competition in the AI chip market. Major firms are fighting for market share as the competition heats up. Yet, given Nvidia's strong history of innovation and Blackwell's transformative potential, the company appears well positioned to sustain its competitive edge, successfully navigate market obstacles, and see its stock price soar to new heights in the upcoming year. In other words, there are both, I believe, top-down and bottom-up perspectives on this. The Blackwell platform from Nvidia is a groundbreaking invention that has the potential to revolutionize AI applications in a variety of industries. Its debut is anticipated to considerably improve Nvidia's financial performance and stock price. The market outlook is encouraging, but investors should exercise caution and keep an eye out for potential concerns due to its superior performance efficiency and scalability. However, given its solid track record and dedication to AI innovation, NVIDIA appears to be headed for continuous growth, which might soon propel its stock price to all-time highs.